Year 2 is more into financial performance metrics, and there are three major ratios which we have to solve question about. One is liquidity ratio, leverage and solvency ratio, and activity ratios. Before we do the question, we should know what are the formulas, so it will be more easy for us to use. Liquidity is the firm ability to pay its short-term debts, and when it comes to liquidity, there are some pet ratios called net working capital ratio, which is current assets minus current liabilities. Current ratio is you take current assets, you divide with current liability, it will become your current ratio. But because it has assets some are slow moving like stock, so we exclude stocks, it becomes quick asset ratio. And the formula is cash plus marketable securities receivable. There is no stock into. This is the only difference between both. So we will divide with current liability. Cash ratio, just to see how much cash you have, you take cash and readily available cash like marketable securities, we divide it with current liabilities. In terms of cash flow ratio, we take cash flow from operation, which is in cash flow statement. Because cash flow statement has three portions. One is operating, financing and investing. So this is cash flow from operation divided by current liabilities. We have current assets minus current liabilities divided by total asset. This is net working capital ratio. So these are all liquidity ratios. When we check the solvency or sustenance of the company, you can sustain in short term or you can sustain in the long term. Both way we have two type of leverages. Ability to pay, one is operating, that is day-to-day nature, which is less than 1 year time. And this is, you take sales, you divide it with earning before interest and tax. When you want to calculate, see the long-term survival of this company, then what you have to do is you have to take the financial leverage, which is long-term in nature, and you have to divide with earning before interest and tax divided by net income. So these are some important formulas. Other than that, we have some capital structure ratio, means how much equity we have, how much debts we have, what is the ratio. So first is debt capital ratio, that is the total debts. So debts means liability and total means current and non-current. So we will divide it with total capital. Capital means equity. Equity can be ordinary. And then we have total debts divided by stockholder equity. Sometimes we don't take total debts, so we take only long-term debts divided by the equity. Liability asset ratio, we take total liabilities, we take total assets, we divide them. And sometimes we calculate earning coverage, means how much income is kept to pay your interest. Earning before interest and tax divided by interest expenses. Every bank who gives you a loan, we want to see that do you have enough money after paying your tax or before interest and tax, that how much you will pay to tax and interest, do you have enough income to pay it, right? So this is a very important ratio for the lenders. Then we have these long ratios, which is okay, we'll discuss once we'll solve the question. These are very important ratios. There are so many questions about activity ratio. Means how actively you are making your sales, purchase, procurements, and in general your operating cycle, right? This is very important. Starting from asset receivable turnover, you take your credit sales net and you divide it with average trade receivable, which is opening receivables plus closing receivable divided by 2. Inventory turnover means how many times in a year you sell your inventory. This is cost of goods sold divided by average inventory. Then we have purchases divided by average accounts payable. This will tell you how many times payable being created in terms of amount, in terms of days. When it is days, you can divide like 365 or 360, whatever is given in the question, and the same ratio account receivable turnover that we just calculate. Same for inventory, that days in a year divided by inventory turnover, right? And then we can have purchase days in a year divided by average payable turnover. So these are activities. Now sometimes we say that how much sale is contributing to the assets. So we take as sales and divide with the average net fixed assets. Then how much asset is total asset contributing to the sale, or sale is contributing to the total asset. This is we can see from this ratio. If we combine all, this will become the operating cycle. Let's start our discussion for the questions. They are based on the same logics and formulas. These are very logical. W company has current assets of $400,000 and current liabilities of $500,000. Now, W company current ratio will be increased by, there are 4 options. First of all, we should know what is our current ratio. Current ratio is always current assets divided by current liability. So, this is we have to see what is the change in assets, current assets, and what is the change in current liability. If we compare, calculate, we can see what is the effect. So the question is, if a company has current asset 400,000, you just divide 400,000 by 500,000, so you will get your current ratio, right? And then see equal change, because sometimes you have equal effects. Means if I pay my liabilities, one effect is reducing liability, the other effect is reducing my current asset as cash. So the net effect is 0. So in this question, let's discuss this option. If we purchase 100,000 of inventory on account, so will it increase the current ratio? First of all, we should divide this with this to see what is the current ratio as of now. Now purchase of 100,000 for an inventory. Purchase inventory is going to increase, and on account is your liability, right? It is going to increase. Right. Now this will become 400,000 will become 500,000, and 500,000 will become 600,000, right? This is what I am going to do it for you. So ratio will of course to change. It will become, what is the new ratio? 0.833, right?
Yeah. The original is 0.8.
So this is very simple. See here, this is 400,000 divided by 500,000. This is 0.8. Now because figures change, 100,000 is increased. This becomes 600,000. This becomes 500,000. If you again divide this one, it will become 0.833. So means the option A, that is the purchase of 100,000 of inventory on account, is going to increase your current ratio. If you test and run the other option, this is going to decrease the ratios. It will not increase the ratios. Peter's company has 2:1 current ratio. In fact, 2:1 current ratio is very ideal, means you have double assets than your liabilities. 2 means your assets are double and your liabilities are half of it, 1 and 2. This is the ideal ratio. The ratio would increase to more than 2:1. Means obviously when you increase your assets, your ratio will become more good, because double is your asset if you have more increase, or other way you decrease your liability.
Right.
Both ways we can have a change in the current ratios. So you will see company sold merchandise on an open account that earned a normal gross margins. Means we sold merchandise and open account, what is going to affect is, it says the current ratio is current assets divided by current liability, and increase in current asset or decrease in current liability by itself increase the current ratio. The sale of inventory at the profit increase current assets without changing liabilities. So if you sold merchandise, means you will add your margins, so your as receivables will create, right? And there is no much liability, there is no liability involved into the transaction because you are selling your inventory to someone, so you are creating a receivable.
Yes.
By adding margins, because inventory at cost, sale on margins. So C is the right answer.